Hello everyone, welcome to the 54th episode of me learning how to trade in Forex. So in the last video we went through which type of analysis is for Forex traders is the best. We went through the technical, fundamental and sentiment analysis, and then this page just basically summarizes that you need all three analysis to be able to become a successful trader. We did the quiz and now we're currently on three types of price charts and how to read them. So, and how to read. The date is 23rd/02/2024. So, in order to study how the price of a currency pair moves, you need some sort of way to look at its historical and current price behavior. A chart, or more specifically a price chart, happens to be the first tool that every trader using technical analysis needs to learn. A chart is simply a visual representation of a currency pair's price over a set period of time. Uptrend, downtrend, sideways trends, uptrend, downtrend. It visualizes the trading activity that takes place during a single trading period, whether it's 10 minutes, 4 hours, 1 day or 1 week. Any financial assets with price data over a period of time can be used to form a chart for analysis. Price changes are a series of mostly random events, so our job as a trader is to manage risk and assess probability, and that's where charting can help. Charts are user-friendly since it's pretty easy to understand how price movements are presented over time, since it's so visual. With a chart, it is easy to identify and analyze a currency pair's movements, patterns, and tendencies. To identify and analyze a currency pair's movements, patterns and tendencies. Look at all these spelling mistakes. On the chart, the y-axis vertical axis represents the price scale and the x-axis horizontal axis represents the time scale. Y-axis is price scale, x-axis equals time scale. Prices are plotted from left to right across the x-axis. Prices plotted from left to right across the x-axis. The most recent price is plotted furthest to the right. Most recent price plotted on the right. So most recent price is here. Back in the day, charts were drawn by hand. Fortunately for us, Bill Gates and Steve Jobs were born and made computers accessible to the masses, so charts are now magically drawn by software. What does a price chart represent? A price chart depicts changes in supply and demand. Price chart depicts changes in supply and demand. A chart aggregates every buy and sell transaction of that financial instrument, in our case currency pairs, at any given period. Aggregates every buy and sell transaction of that currency pair at any given moment. A chart incorporates all known news as well as traders' current expectations of future news. Incorporates all known news as well as traders' current expectations of future news, as well as traders' current expectations of future news. When the future arrives and the reality is different from these expectations, prices shift again. Future arrives and the reality is different from these expectations, prices shift again. The future news is now known news, and with this new information, traders adjust their expectations on future news and the cycle repeats. So, future news is now known news, and with this new information, traders adjust their expectations on future news, and the cycle begins again. A chart incorporates all known news as well as traders' current expectations of future news. When the future arrives and the reality is different from these expectations, prices shift again. Future news is now known news, and with this new information, traders adjust their expectations on future news, and the cycle begins again. Charts blend all activity from the millions of market participants, whether they're humans or algorithms. Charts blend all activity from the millions of market participants, whether the transaction occurred by the actions of an exporter, a currency intervention from a central bank, trades made by an AI from a hedge fund, or discretionary trades from retail traders. A chart blends all this information together in a visual format technical traders can study and analyze. Types of price charts. Let's take a look at the three most popular types of price charts: line chart, bar chart, candlestick chart. Now we'll explain each of the Forex charts and let you know what you should know about each of them. Three most popular types of price charts. So that's line charts, bar charts, candlestick chart. Line chart. A simple line chart draws the line from one closing price to the next closing price. So line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see that the general price movement of a currency's pair over a period of time. When connected via a line, shows the price, shows the general price movements over a period of time. So bar. It's simple to follow, but the line chart may not provide the trader with much detail about price behavior within the period. simple to follow, but doesn't show much detail regarding price behavior within the period. All you know is that the price closed at X at the end of the period. You have no clue what else happens. But it does help the trader see trends more easily and visually, compare the closing price from one period to the next. This type of chart is usually used to get big picture view of price movements. So usually used to get a big picture view of price movements. The line chart also shows trends the best, which is simply the slope of the line. Shows trends the best. Some traders consider the closing level to be more important than the open, high or low. By paying attention to only the close, price fluctuations within trading sessions are ignored. Here is an example of line chart for EUR/USD. Okay. Bar charts. Unfortunately, this is not a chart at a bar. Well, hey, a bar chart is a little more complex. Shows the opening and closing prices as well as highs and lows. Bar charts help a trader see the price range of each period. Help to see the price range of each period. What do they call it? High, low, open, close. Where's the one we did before? High, low, open, close. High, low, open, close. Yep. Price range for each period. Bars may increase or decrease in size from one bar to the next or over a range of bars. Bars may increase or decrease in size from one bar to the next or over a range of bars. The bottom of the vertical bar indicates the lowest traded price for that time period, whilst the top of the bar indicates the highest price paid. So let's do that. Bottom vertical bar. So low. The lowest price, the lowest traded price for that time period. High, the highest price paid for that time period. Vertical bar itself indicates the currency pair's trading range as a whole. Trading range as a whole. As the price fluctuations become increasingly volatile, the bars become larger. As the price fluctuations become quieter, the bar becomes smaller. So, if high volatile bars become larger, if low volatile bars become smaller. The fluctuations in bar size is because of the way each bar is constructed. The vertical height of the bar reflects the range between the high and the low price of the bar period. The price bar also records the period's opening and closing prices with attached horizontal lines. Opening price, closing price for that time period, The horizontal hash on the left side of the bar is the opening price, and the horizontal hash on the right side is the closing price. Here is an example of bar chart for Euro USD. So difference, that's a line, whereas this one we can see like, yeah, I don't really know how to describe it, to be honest. Take note, throughout our lessons you will see the word bar in reference to a single piece of data on a chart. Wait, this is the right section, right? Yeah. A bar is simply one segment of time, whether it's 1 day, 1 week, or 1 hour. When you see the word bar going forward, be sure to understand what time frame it is referring. So they say a single piece of data, that assuming that means one single like bar. So one that bit there, one that bit there. A bar is a segment of time. Is one segment of time. When you see the word bar going forward, be sure to understand what time frame it is referring. Bar charts are also called OHLC charts because they indicate the open, so O, high H, low L, C, close for that particular currency pair. A big difference between a line chart and an OHLC, open, high, low and close chart, is that the OHLC chart can show volatility. Here's an example of a price bar again. Open, the little horizontal line on the left is opening, top of the vertical line defines the highest price of that time period. The bottom of the vertical line defines the lowest price for that time period. The little horizontal line on the right is the closing price. Okay. Candlestick charts. Candlestick chart is a variation of the bar chart. Candlestick charts show the same price information as a bar chart, but in a prettier graphic format. Shows the same price information, but in a prettier graphic format. Many traders like this chart because not only is it prettier, but it's easier to read. Candlestick bars still indicate the high to low range of a vertical line. Oh, I see why sometimes open is on the left, because then you can like it goes from left to right, so you can like link it up maybe. Maybe. Candlestick bars still indicate the high to low range of a vertical line. Don't think I need to write that, to be honest. However, in candlestick charting, the larger block or body in the middle indicates the range between the opening and closing prices. Indicate the high to low range with a vertical line. The body in the middle indicates the range between opening and closing prices. Candlesticks help visualize bullish or bearish sentiment by displaying bodies using different colors. Help visualize bearish or bullish sentiment by displaying bodies using different colors, so red and green. Traditionally, if the block in the middle is filled or colored in, then the currency pair closed lower than it opened. Oh, this is using black and white, but in the tutorial watched some other website, it's actually like different colors, so green and red. But black and white could still do. Traditionally, if the block in the middle is filled or colored in, then the currency pair closed lower than it opened. In the following example, the filled color is black. For our filled color blocks, the top of the block is the opening price, the bottom of the block is the closing price. If the closing price is higher than the opening price, then the block in the middle will be white or hollow or unfilled. So, upper shadow, right, I don't even know what upper shadow means. So high, same, low, still the same, it's just the open and closing, so that's different. So if the opening price is higher than the closing price, then you shade it in. If it's not, then you don't shade it in. Color of body is different if opening for higher opening price than closing price, or higher closing price than opening price. We don't like to use the traditional black and white candlesticks. They just look so unappealing. Ah, here we go. And since we spent so much time looking at charts, we feel it's easier to look at a chart that's coloured. A colour television is much better than black and white television, so why not splash some colour on these candlestick charts? We simply substitute green instead of white and red instead of black. This means that if the price closed higher than it opened, the candlestick would be green. So if the price closed higher than it opened, it would be green. Closed higher than open, it would be green. Yep. Cool, that makes sense. We could get a cheeky screenshot of this as well. So let's do that. Boom, boom, boom. If the price closed lower than it opened, the candlestick would be red. In our later lessons, you will see how using green and red candles will allow you to see things on the charts much faster, such as uptrends, downtrends, and possible reversal points. For now, just remember that on Forex charts we use red and green candlesticks instead of black and white, and we will be using these colours from now on. Check out these candlesticks, babypips.com style. Oh yeah, you know you like that. I still don't get what this lower shadow and upper shadow thing is, so yeah. Here an example of a candlestick chart for Euro USD. Isn't it pretty? The purpose of candlestick charting is strictly to serve as visual aid, since the exact same information appears on an OHLC bar chart or open, high, low, closing. The advantages of candlestick charting are: candlesticks are easy to interpret and are a good place for beginners to start figuring out chart analysis. Candlesticks are easy to use. Your eyes adapt almost instantly to the information in the bar notation. Plus, research shows that visuals help with studying, so it might help with trading as well. Candlesticks and candlestick patterns have cool names such as the shooting star, which helps you remember what the pattern means. Candlesticks are good at identifying market turning points. Trend reversals from an uptrend to a downtrend, or a downtrend to an uptrend. You will learn more about this later. There are many different types of charts available, and one is not necessarily better than the other. The data may be the same to create the chart, but the way that data is presented and interpreted will vary. Each chart will have its own advantages and disadvantages. You can choose any type of or use multiple types of charts for technical analysis. It all depends on your personal preference. Now that you know why candlesticks are so cool, it's time to let you know that we will be using candlestick charts for most, if not all, of the chart examples on this site. Fares. Putting it together, there are several different types of price charts that traders can use to monitor the FX market and other financial markets. Keep things simple as you begin reading price charts. As you find your chart preferences, look for the proper balance of having enough information on the chart to make good trading decisions, but not so much information that your brain is paralyzed and can't make any decisions. Finding the right combination is different for every trader, so it's important to start with the basics before you start working on your way into using technical indicators, which we'll cover later. Quiz time. Types of charts. Charts are cool because they make it easier for us to present exchange rates in a visual and organized manner. Make sure your knowledge about charts is in tip-top shape by taking the short quiz. If I want to view the line timescale on the chart, I should check out the x-axis. On the chart, the y-axis, vertical axis, represents the price scale, and the x-axis, horizontal axis, represents the time scale. Prices are plotted from left to right across the x-axis. The bar chart is also called the OHLC chart. Bar charts are also called the OHLC charts because they indicate the open, the high, the low, and the close for that particular currency. What does the peak of the upper shadow of candlestick indicate? That's the OH, so opening price. The peak of the upper shadow of candlestick indicates a higher price. Oh yeah. Wait, they should call it HOCL, not OHLC. God, that's confusing. Price charts blend activity from millions of market participants, except trades made by an AI from a hedge fund. False. Whether the transaction occurred by the actions of an exporter, currency intervention from a central bank, trades made by an AI from a hedge fund, or discretionary trades from retail traders, a chart blends all these information in a visual format technical traders can study and analyze. What kind of chart draws together one closing price to the next closing price over a certain period of time? That's a line chart. Simple line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. What kind of chart is best used to show trends and get a big picture view of price movements? Big picture. That's the line chart as well, isn't it? The line chart is usually used to get a big picture view of price movements. This type of chart also shows trends the best, which is simply the slope of the line. When using the bar charts, as the price fluctuations become increasingly volatile, the bars become larger. As the price fluctuations become quieter, the bars become smaller. True. The vertical bar itself indicates the currency pair's trading range as a whole. As the price fluctuations become increasingly volatile, the bars become larger. As the price fluctuations become quieter, the bars become smaller. What does the tip of the lower shadow of a candlestick indicate? Low price, because the upper shadow is the high price. The tip of a lower shadow of candlestick indicates the low price. The following are advantages of candlestick charting, except candlestick charting precisely predicts future price movements to help you consistently open winning trades. That's false, obviously. Although candlestick charts and patterns, which you will learn more about really soon, can give you a sneak peek into the psychology of the market and potential future moves, no type of chart can give you the precise predictions of future price movements. I know, sucks, right? What is the first tool that every trader using technical analysis needs to learn? Price charts. A chart, or more specifically a price chart, happens to be the very first tool that every trader using technical analysis needs to learn. Cool. What is support and resistance? So what is support and resistance? 23rd 02/2024. Support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have their own idea of how you should measure support and resistance. Let's take a look at the basics first. Resistance, support. This image is my support right here. So, look at the diagram above. As you can see, this exact pattern is making its way up, a bull market. When the price moves up and then pulls back, the highest point reached before it pulled back is now a resistance. Resistance, when the price moves up and then pulls back. Highest point reached before it pulled back is now resistance. When the price moves up and then pulls back, the highest. So this should be called the highest point reached. The highest point reached when the prices move up and then pulls back. Yep, resistance levels indicate where there will be surplus of sellers. Indicate where there will be a surplus of sellers. When the price, so there's more sellers than buyers. When the price continues up again, the lowest point reached before it started back is now support. The lowest point reached. When the price moves down and then pulls back. Support levels indicate that there will be a surplus of buyers. Where there will be a surplus of buyers. In this way, resistance and support are continually formed as the price moves up and down over time. The reverse is true during downtrends. In the most basic way, this is how support and resistance are normally traded. Trade the bounce. Two ways to trade support and resistance. Trade the bounce, which is when buy when the price falls towards support, sell when the price rises towards resistance. Trade the break, buy when the price breaks up through resistance, sell when the price breaks through down support. So buy when the price breaks through resistance, so if it goes above here you start buying. Sell when the price breaks down through support, so if it gets here you sell it, so you short it. Trade the bounce, buy when the price falls towards support, so it starts buying like here when it falls to support. Sell when the price rises towards resistance, and then you start selling here, I'm assuming somewhere along here. A bounce and break. Say what? If you're a little bit confused, no need to worry, as we'll cover these concepts in more detail later. Plotting support resistance levels. One thing to remember is that support resistance levels are not exact numbers. So support and are not exact numbers. Oftentimes you'll see a support resistance level that appears broken, but soon after find out that the market was just testing it. With candlestick charts, these tests of support and resistance are usually represented by the candlestick shadows. Notice how the shadows of the candlestick break past support but end up closing above it. Support and resistance levels can appear to be broken, but it could be just the market testing it. These tests are usually represented by the lows, by the highs and lows of the candle stick. So let's get a photo of this, because it's actually quite a good diagram or photo. Let's do 49.99. Notice how the shadows of the candles tested the 1.4700 support line. Those times it seems like the price was breaking support, but in hindsight we can see that the price was merely testing that level, because it never actually got below it. So how do we know if the support and resistance were broken? How do we truly know support and resistance were broken? There is no definite answer to this question. Some argue that a support resistance level is broken if the price can actually close past that level. However, you'll find that this is not always the case. Let's take our same example from above and see what happened when the price actually closed past the 1.47 support level. In this case, the price is closed below the 1.47 support level but ended up rising back up above it. If you had believed that this was a real breakout and sold this pair, you would have been seriously hurting. Look at the chart now. Look at the chart now. You can visually see and come to the conclusion that the support was not actually broken. It is still very much intact and now even stronger. Support was breached, but only temporarily. To help you filter out these false breakouts, you should think of support and resistance more as zones rather than concrete numbers. should be thought of as zones. One way to help you find these zones is to plot support resistance on a line chart rather than a candlestick chart. Could plot support resistance on a line chart. As it only shows the closing price. Candlesticks show highs and lows, which could be misleading because oftentimes they're just knee-jerk reactions of the market. It's like when someone's doing something really strange, but when asked about it, he or she simply replies, sorry, it's just a reflex. When plotting some support and resistance, you don't want the reflexes of the market, you only want to plot its intentional movements. Support and resistance. You don't want to plot the reflexes of the market. You want to plot its intentional movement. Looking at the line chart, you want to plot your support and resistance lines around areas where you can see the price forming several peaks or valleys. Let me read that again. Looking at the line chart, you want to plot your support resistance lines around areas where you can see the price forming several peaks or valleys. Support zones. Resistance zones. Plot support and resistance. Around areas where you can see the price forming several peaks or valleys. Whoops. Actually, I do want that to be there, so support zones. I think you would need to have like a right how would you call it, like a right overview picture, not like a close-up one, because this could also be like a resistance level though here, couldn't it, if you just only looked at like this section of the graph. So to do this you would need to have a pretty big section of the graph. Support, bouncing it up, bouncing it up. This could be a mini resistance here, but instead it's actually all the way out here. So other interesting tidbits about support and resistance. When the price passes through resistance, that resistance could potentially become support. When price resistance could potentially become support. The more often price tests a level of resistance or support without breaking it, the stronger the area of resistance or support is. Often prices test an area of support and resistance without breaking it, the stronger the area of support or resistance is. When a support or resistance level breaks, the strength of the follow-through movement depends on how strongly the broken support or resistance have been holding. When a support or resistance level breaks, the strength of the follow-through move depends on how strongly the broken support or resistance had been holding. When a support resistance level breaks, the strength of the follow-through move depends on how strongly the broken support or resistance had been holding. So we can see minor resistance, strong support, minor resistance, minor support, major resistance tested many times, 1, 2, 3, minor support once, minor support once. This has been tested loads of times. Minor resistance because only tested 2 times. This has been tested 2 times, which is why. Oh no, this has been tested 1 time, so it's minor. This has been 2, so it's strong. Surely that wouldn't be a strong one as well then, because it's been tested once and twice, but okay. With a little practice, you'll be able to spot potential Forex support and resistance areas easily. I put a little ball at the end so it looks like it'll bounce back. Okay. In the next lesson, we'll teach you how to trade diagonal support resistance lines, otherwise known as trend lines. I'm going to leave this episode here. Thank you very much for watching. And the next video will cover trend lines, so I will see you then. Peace.